I'm just driving. So Dan, please introduce our trainer.
Let me just finish posting on. Yes, good evening, everyone. My name is Dan Alejo. I'm one of the Regional Marketing Director in LA area. So our office is in Long Beach, but been on the business for 8 years. And our trainer for tonight is one of the person that has a serious license in our company, in our team. So actually, I think there's only two, huh? Ray, on our team, it's you and Kuya Sol.
Yeah, I think so.
So he's really knowledgeable on the topic that he's going to discuss right now. He's been on the business for 2 years. Is it two?
With WFG, but overall, I've been in the financial industry for over 21 years.
So he's a financial advisor too before in JP Morgan Chase. So he's been there for 6 years, but he worked too in Bank of America for 12 years. So yeah. So Ray.
Yes. All right. Well, thanks, Dan, for the intro, and yeah, definitely. Today's topic is about annuity, but at the same time, too, it's to help a lot of our new agents who's about to take the exam, either the next week or two, hopefully sooner, no later than a month. After 2 weeks, usually you just forget anything that you read. So I probably most people, we tend to procrastinate. So if you could start review, take the exam, study to pass. So today we're going to be talking about the licensing preparation. So the goal is discuss about that, and then at the same time the illustrations on the licensed agents today. And really it's not rocket science to create illustration, and it would also help you increase your knowledge, and also at the same time cultivate some opportunities for people who are about to retire, and so on and so forth. So I'm gonna jump right in. I'm gonna make it quick, and then we'll have Q&As afterwards. So let me just share my screen. All right, you guys can see this, right? Yes?
Yes.
All right, perfect.
Yes, we see it.
All right. So this is a preparation, and well, if you have any questions, please write it down, and then afterwards, just we'll go over the Q&As. So again, this is a 1 second. Where am I?
Happening.
Bear with me. There you go. Technical.
Okay.
Sorry about that. Okay. I think we're good, yeah. So disclaimer, okay, so this, I know we're gonna go over the annuities. This topic, it's not gonna guarantee you that you're gonna pass the exam, but it'll just give you some insight on preparation for the exam, okay? So annuities, what exactly is annuities? So as people are living longer, this is becoming a great tool for a lot of the people who wants to use this as a tool for income down the road. And most people would always say, hey, what is it, a short term, long term? This is a long term strategy for most of our clients. So annuities are offered through insurance companies as another form of protection. So like life insurance, as you can see, it's most people get life insurance to offset the losses due to death. So in case we die or the client dies sooner, then while annuities is for people who live longer. So a lot of times too, when we retire, we rely on Social Security. Like most people would always say, hey, my plan for retirement is Social Security, possibly pension too. So now most of those people who work for 20, 30 years over when they're about to retire, whatever 401ks, retirement plans, IRAs they have, they can actually convert that to an annuity. And that's it's a form of an income in addition to those three things, such as Social Security, pension, and the required minimum distribution on their IRAs, etc. So, understanding annuities. So, if you give a lump sum, so I'm going to give you just a scenario: 30-year-old putting in 401k plan, IRAs, etc. for the next 30, 40 years. Fast forward, by the time they're 59 and a half, you can then roll it over into an annuity. And then we'll go over some of the examples later on down the road, maybe the next 10, 15 minutes. So you put in a lump sum, I'll just use a whole number, $100,000. And in exchange, you will get a series of payments, either for a certain period of time, or it could be a lifetime. So depending on how you understand your client's needs, you just have to know first, you have to do PFS. So PFS is the personal financial strategy. So you got to know your client's lifestyle. Like what kind of lifestyle do they want to live when they retire? So the monthly check is determined by the size of the account. So later on too, we'll go over that. You will see how you can grow the money and then convert it to income or pension, if you will. So contract period. So some of the people, when they say, hey, I want to, what exactly is, if I do the annuity, can I get an income right away? And this one here, the first thing, the immediate, so you put in 100,000, single premium, you can get a fixed amount of income every single month. And then this is the annuitization is what you call it here. Or if you don't want an income right away, you can defer it and then grow it afterwards. So this, we're not going to discuss about variable. That requires securities license. So we don't want to talk to our clients about that until you have your securities license. So, but just for the sake of our training today, variable is your money, your investment basically would fluctuate. So if you look at your investment like this way, so your money goes like this. We don't want that. All right. And then now the annuitization is the process of when you want your money to be converted to an income or pension, this is annuitization. So annuitization is a traditional method of payout. You convert or trade your annuity into a regular income payment. So you will see it also later on. So for example, on a lifetime payment, what that means is you put in 100,000, the insurance company will give you a lifetime income. And then if it's period certain, what that means is, let's say if you're 60 years old, example, 60. So 60 years old to, let's say, 80 years old. So if you want high income on your money, a period certain is a good strategy. Then life with period certain is you get a bigger amount here on income. And then after, let's say from 60 to 80, you have a high income. After 80, it's going to go down. Your income's going to go down. And then joint survivor, what that means on the exam is you have husband and wife as to getting annuitizing like a 401k, converting it to an annuity, and then you annuitize it. The wife or husband gets income, and then upon death of the husband, wife also gets the income. So you can do both, two, or upon death of one, you also get the income continues. So here's like I mentioned earlier about the 60-year-old. So the lifetime payment earlier is if you're 60, it'll just continue. Really that simple. If the question, I don't even remember how they will ask you on the questionnaire, but just think of it as a lifetime payment. That's one of the options when you see lifetime income, straight life or pure life, if you see that. Period certain, it's the same thing too. You get an income from 60 till 80. After that, it's going to go down. Actually, I'm sorry. This is the period certain. This is only you get an income from here to here. If one passes away, let's say I'm just going to say John Wick. This is John Wick. So John Wick passes away at age 70. What happens is between 70 to 80, the beneficiaries get that income. And then here, John Wick again. I'd like to use John Wick because we just watched John Wick. So 60 to 70, you get the highest income. Highest income here. After 10 years, so let's say, for example, you get $12,000 per year, the first 10 years. After that, it's going to be $6,000 per year. So something like that. And then same thing too with the joint and survivor. So payment to two or more annuitants. So husband and wife gets it. And then upon death of one, then the survivor gets the rest. Usually it's a lot lesser here, the amount of income. But this is one of those strategies where if their retirement income is not enough for both, then you can pick a joint and survivor option. So that way, upon death of one, it continues to whoever survives. And then now the question too here is, what is a qualified and non-qualified? So qualified, when we see 401k, 401ks are qualified. Traditional IRAs are qualified money. Even Roth is still considered a qualified money. 403bs, 457s, these are all qualified. So all the contribution, it gets taxed when you withdraw the money. So if you put your 401k into an IRA, your 401k into an annuity, and then you take money out, you get taxed. Now, non-qualified is just money in the bank. So you have a client who's got a CD and the rates are low and they want something else, and you offer an annuity. Those are considered non-qualified money. So any money you have in your bank account, savings, checking, CD, those are all non-qualified. And then the contribution limit, of course, there's no limit on this part here for the non-qualified. On qualified money, the reason why it'll say there's limits is because 401k, for instance, if you have Once you convert that into an annuity, you can't add more money into it. So that's why there's contribution limit. Suitability is the same thing too. Is you got to know who your client is. If you can't just immediately offer an annuity, you got to know first what's important to them, and if they have any other reserves. You can't just put all of their money into an annuity. Just do the PFS. So that's the personal financial strategy. So talk to whoever invited you to this training on what suitability do we follow when offering annuities. And then tax on withdrawals. So any money you withdraw or you take out on an annuity, if it's qualified, then yes, you get taxed. Now here it says non-qualified, you don't get tax. True. However, this kind of goes together, these two, the tax on gains. So if you make any withdrawals on a non-qualified money, you get taxed on the gains. So let's say you put in the original 100,000 and from your savings or a CD, and then you put it in an annuity. Annuity now, let's say it's 120,000 value. So from 100K to 120, then the 20,000 you get tax on the gain. So any portion of the withdrawal every single month, and then at the end of the year you get a 1099. Clear so far? All right. I think that was it. Hang on one second. Let me just give you an example now. 1 second. So, see here, John Wick. So he originally put in 100,000. This is on the North American strategy, ladder strategy. Sorry, 1 second here. Here. So 100,000. So the option we picked here is there's BlackRock, Loomis, S&P. So 34% on BlackRock, 33% on Loomis, and 33% on S&P. You have an option to put 100% here. But in this example, we split it into 3 different indices. So if you look at how this strategy works, is the first year, assuming the rate of return here is 5%. So from October 2023 till October 2024, let's say it's 5% rate of return times 170%. So that's why we love this participation rates. This is a good strategy for your clients who's looking at growing at first. So let's say he's 60 years old and then he doesn't want to retire yet until age 70. So what we want to do is we want to grow it. And then afterwards, we want an income. So in this example, John Wick wants to get an income after 70. So fast forward, after 10 years, the highest that money would grow is 568,000. Lowest it can be on 100,000 is 347 at 13.26% rate of return. And if we look at the most recent 10 years, that 100,000 is going to be valued at 384,000. So now, after 10 years of growing it, we want to convert it to an income strategy. So in this example, we're using Athene as an income writer. with some options as far as doubling. It has a rider that would double your income if in the event that you can't function 2 out of the 6 activities of daily living. So now fast forward, John Wick is now 70 years old. If, for example, he wants to activate that income right away, so because this product has a 25% bonus on this amount that grew on the North American strategy, the ladder strategy, the income calculation is this based on the 499,000 times 6.1%. That's going to give him a 30,480 income per year. God forbid if he gets sick within 12 months. See this one here. There's a disclaimer here that you have. You can't be sick within 12 months and 1 day for this particular company. There's some it's immediate, but for this particular with Athene, it's you have to wait at least 12 months and 1 day if you can't function 2 out of the 6 activities of daily living. And then every year that you delay, so for instance, he doesn't activate the income right away. So at 72 here, you see how it would go up, 6.3. So from 30,000 to 37,000. Remember earlier when I said about the required, the qualified and non-qualified? So since this money is a qualified money, at age 72, if he doesn't activate the income, this company will have to require you to do the RMD. So it's RMD friendly. So most of the annuities that you're going to be working with are RMD friendly. So our job is to ensure that we tell our clients that upon age 72 and a half, if they don't exercise the income during that time, then our job as as an advisor or as a financial
professional,
I guess what's the
Licensed financial professional.
there we go, the license, thank you. So as a licensed professional, so our job is to let the client know, hey, we need to set up an automatic RMD for your for the money you have there. Otherwise, there's going to be some tax consequences when if we don't set up an automatic RMD for those annuities. So in essence, if we second here. So do you have any questions so far on this illustration?
Can I say something?
Yeah.
Can I add actually? So what Ray is saying for the North American, that is that strategy, the secure horizon, that is for growth. So if the client does not stop working yet for 10 years, you can put it in a growth or an accumulation annuity. So just to grow the money because they don't need it yet. Now, and then, so after the 10 years, you can then roll it over to another strategy, which is the Athene one, and that is for income for life. So that's guaranteed income for life. So I just wanted...
Or we could do, it's not necessarily a rollover, but a 1035 exchange.
Okay. And then also what RMD means is the required minimum distribution, because when you reach 72, that is the government or IRS would let you will have you do the RMD. It's a requirement. So yeah, that's...
Or else you're gonna get penalized.
Yes.
Yeah, it's 50% penalty if you don't do this. So it's really important. to work with our clients to ensure, if it's qualified money, let's make sure that it's always in our yearly reviews with our clients. So really, to sum it up, going back to the annuities, is that annuities really is, in general, it's used for a retirement vehicle for income down the road. And if you don't need income yet, then this is where you would say, hey, you know what? I still don't have enough. I'm going to continue working maybe until maybe another 10 more years. If he's, in this case, 60 years old, and he'll say, hey, I'm going to continue working till 70. Then grow that money, because the best part here is that your principal, so the 100,000 is protected. So if the market goes down, then your money stays the same. So if you look at this scenario here, or this example, so each year the money gets locked at 103. So even if the market goes down, 103 will stay the same. Even if it's this one, it's zero, nothing, or the market went down, the value the following year it will still continue to be 103. So this is the beauty of this particular strategy.
Fixed.
Now, do we have any questions yet?
Ray, this is Mirna. I just have a question regarding the RMD. When
Yes.
you are setting up the distribution account, is it possible for you to just set up automatically, like, hey, at age 72, you're getting the distribution?
Thank you for that question. So each of the, I'm going to use the example with Athene. So Athene, so there's forms that we're going to be, we have access to it. So you go and access those forms and then fill out automatic RMD at age 72. That way, but just make sure our job is to every year just to make sure, hey, because it's if we don't check on it, sometimes there could be errors that could happen, or it could be a glitch. So when we submit that form for automatic on the RMDs, then there's a chance that they could be penalized. The good thing too is, example, they started setting up the income. They activated the income at year one or a year after. So this 33,000 will also act as an RMD for that year. So the RMD should,
about it.
huh?
No need to worry about RMD, sir.
Yeah, once you activate the income, don't worry about the RMDs anymore, because it's going to satisfy it.
Another question.
Okay.
Thank you.
For a client who has several annuities with regards to the RMD, can she get that from one company, or is it mandated to kind of distribute it among
So
the annuities?
Yeah, actually, thank you for that question. So if you have, some clients, they have several annuities. So as long as you've set, so if you add up, let's say, the total annuity is, let's say, $1 million. So if you're age 72, there's a table. So if $1 million, divide that by 27.4, that's when you reach 72. The required minimum distribution, if you have a total of $1 million, is $36,496.35. So as long as you've satisfied the $36,496 for that year, let's say you only took it from one account, then you're good. You just have to let the other annuity company know that the RMD has been satisfied for 2023. And disclaimer, not a tax advisor, but I've seen this happen several times. So it's a good practice to always, hey, if you just want to use this one particular annuity as to satisfy your RMD, then yeah, you can.
Okay, thank you.
Thanks, Ate. Any more questions?
Actually, another question.
All right.
If I'm a client and I have an annuity, one, I'm getting immediate distribution already, and I'm 72. At age 73, I will be required to get my RMD. So that will go through to the other account that I probably have and start my RMD from that account? Or will the immediate distribution will be part of the amount that is already being withdrawn from the annuities?
So like this example right here.
Uh-huh.
So if you exercise the income, let's say 30,000. If we look at the table for RMDs, so at 72 they use a 27.4, 26.4, and it goes on and on and on. So if we just go by the 72, age 72, so as long as based on the total amount of annuity you have, if it's the qualified money satisfies the 27.4%, then you're good.
Okay, so whether that is already being annuitized.
Yes.
Okay.
Yep.
Thank you.
So you don't have to get another satisfy another withdrawal to meet the RMD. As long as you this 30,000 is enough. So if we use 499 678, but essentially it's actually not this amount, but it's where you going by the 384 for the RMD. So if we do 384, 368, divide that by 27.4. So the RMD for this amount is 14,028.
A year. Mm-hmm.
And then the following year it changes based on you just follow the table for RMD table. And we can provide that to our clients. And it's a good way to, make that phone call and just follow up, do your annual review and just say, hey, let's make sure everything is all squared away for your RMDs. And also it's a good way to also ask for, maybe they know somebody. So it's always a good way to reach out to those existing clients and then ask for more business.
Okay. Does that affect the RMD? Does that affect the, remember when you say keep the money, when you sign in the contract, you choose whether to keep the money there for 5-10 years or whatever.
Mm-hmm.
When you start your RMD, when you start your annuitization, say less than the 5 year that your contract is written, there is a percentage of like a penalty or is that a surrender charge that you call?
On which one was that out there?
That if you have an annuity that you would like to keep for 5-10 years,
Mm-hmm.
Say I'm 65, if I withdraw, there is a penalty if it's less than the 5 year contract.
Yes. So I'm glad you mentioned that too, because on annuities, when we talk about uh, annuities, there's most people would say, okay, is there a charge? So if I have a 10-year in this particular example, this is a 10-year strategy. So if I make if I withdraw money, so they would allow you to make a 10% withdrawal at no charge. However, that's the surrender charge is what it's called. So all annuities, although when you put in the money in, there's no fee, but when you take it out, it's called the surrender charge. So every year, as for year one, the fee, if you take more than 10%, it's going to go, it'll be about 9%. So it'll be 9, 8, until it's after the 10th year, it'll be 0. So if you take more than the 10%, then yes, you will be penalized with a surrender charge.
But if that is equal to or less than your RMD amount, say I invested my money at the age of 70,
Mm-hmm.
but I plan to keep it there for 5, 10 years, but my RMD starts at 73,
Right.
will that be
Penalized.
part of the surrender charge if it's
No. So
No.
because these strategies are RMD friendly, so as long as when we submit this kind of contract for a client, we'll let them know, and we'll also let the fee know that this is a qualified money. So if it's from a 401k qualified money, or if it's from an IRA qualified money again, and then letting them know that at 72 there's going to be a required minimum distribution that will have to be exercised. So for example, in this scenario, at 72, let's say you don't want to activate the income yet, then you can just do the RMD based on
The 14%.
this value right here. Or you could say, I'm just going to I'm going to use this value here. I'm going to go. Hang on. All right, here we go. So if you don't exercise the income during year 1, 2, so year 2, let's say this was the value. So now the RMD is going to be based on 50576. So 50576, divide that by 27.4. 776. 27. So it's 18,000 is going to be your required minimum distribution for the 505. Although in this, sorry, 1 second. Although here it says that if you exercise your income at 72, it says 37,000. But since you didn't activate it, you can just let Athene know, hey, I want the RMD. Because if you don't do it, let's say you forgot it, your client's going to get a notice from IRS and they're going to get penalized 50%. So does that answer your question out there?
Yes, very good. Thank you very much.
Right.
Can I add, Ray?
Huh?
Can I add something?
Yeah.
Yeah, usually, ate, our RMD is always the lesser to our allowed withdrawal percentage. That's why it will not gonna get it will not gonna have any penalty or problem with our contract because it's always lesser than the percentage that is allowed without penalty. And usually with the like what Ray's example is, if it's 10%, That's for a teen. So different company has different percentage of allowable withdrawal. Example is nationwide. If you get a nationwide product, that's only 8% a year. That's allowable without penalty.
Good to know.
Thank you.
Thank you.
And so another thing too. So let's say, for example, you did the accumulation with North American earlier. So after 10 years, you said, hey, Ray, I want an income strategy because my income right now is just, I'm going to be relying on Social Security and then this money. Let's say if the scenario is that he gets married and then gets an extra income now as a couple, and he decides, you know what, I'm not going to exercise the income for this particular strategy. 10 years after, fast forward here, 1 second. All right, right here. So 10 years after, he's got this money now. So now you have an option to either move that to another strategy, or, I mean, he's going to be what? So 60, so he'll be 80 by then. So it's either he can take big chunks right here, move it to another strategy, or so this could be another opportunity for you after every 10 years. So yeah, that's one good thing about the annuities, is that after the surrender period is over, then you can put them into another strategy, maybe split them into 2 or 3 different strategies then. For the ones that are going to be taking the exam, it really is, you're probably not going to get too many questions about annuities, but the most important really is just understanding what an annuity is. And it's a financial product that is designed to pay out a steady amount of cash over time. Or you could just grow it first. That's the accumulation. And then the other one is going to be the distribution. So growth first and then income, or depending on how you understand your client's needs, that's when you decide whether or not to offer them another product down the road. Maybe when you take the securities license, there's other products too. So that would be another session.
Right. Quick question.
Yeah.
So I just want to understand, some clients will be asking about rolling over their Roth IRA, which is supposedly post-tax or after-tax, into an annuity. I don't understand the process.
Okay.
If you could just explain that one.
So thank you, Ivy, for that question. So because it's still considered a qualified money, although yes, you didn't, it's after-tax dollars. But remember, the Roth, depending on how old you are, so if you're 59 and a half and younger, there's still a 10% penalty for if you withdraw money out of a Roth. So you have to be at least 59 and a half and over to consider doing rolling it over into an annuity. Now, secondly, because it's last in, first out, meaning if at age 59 and a half, you put in the allowable contribution of $7,500 per year. So there's still that 5-year window of you having to potentially be taxed on that money. So you have to look at it from okay, when was the last time you contributed to your Roth? If it's been at least more than 5 years, then it'd be a good strategy to move it into an annuity. Now, some may say, you know what, if they agree to the idea of, yeah, you know, if the last contribution I made was, let's say, 3 years ago, and I just put in the 7,500, and then prior to that I never had any contribution, then that client will just be taxed on the gains for that 7,500 that they put in. So sometimes they'll just say, oh, you know what, it doesn't matter, I'll eat the tax due for that year, because, you know, you're offering them a much better solution for the product.
Cool.
Any more questions on this? Are you guys awake? And I know, thank you so much for taking the time on the Sunday. I know we have 12 more minutes, and
Christine Ginto has
Yeah.
a question. Licelo's saying, Christine?
mhm.
Hi, this is Christine.
Hi.
So once you start your annuitization, does the company stop investing your money?
Thank you for that question. Yes, it does stop the investing, but depending, so for on the fixed side, it's all they have a disclosure there that upon annuitization, they basically would stop, because now they're going to focus on giving you that lifetime income. So the growth on what you've originally put in basically stops. So yeah, it's sometimes most people would say, oh, you know what? Oh, wait a minute. Let me start thinking about it. If this is the best solution, or maybe if they have, for example, if they have a 500,000 money on an annuity, maybe split that, put 250 on a growth or accumulation, and the other 250 converted to income strategy. So just think of what kind of lifestyle do they have? Are they going to continue working? So account the PFS is really important, because then you will know whether, say, if after 10 years, if the money left over is still, let's say they started out with maybe 250, and then after 10 years, leftover funds is 160. After 10 years, you can take it out of that contract because it's out of surrender charge. So then you can maybe grow it again. So yeah, there's ways to create a good strategy, like maybe a ladder strategy for the client. So that way they get, let's say on a 500, 250, and then 250 income. So maybe you activate one income, the other one gets activated after 5 years. So there's a pay increase. But every 5 years, you can then say, hey, you know, depending on what there's always life-changing event. So each year we don't know what's going to happen. So that's why this part here, when it comes to annuities, yes, it's great to have this, but it's also a good way to have a buffer or have this as a protection for the client. So yeah, PFS, it kind of goes back to PFS, personal financial strategy.
I have another question.
Yes.
So I rolled over my 403b to an annuity.
Uh-huh.
So it's a pre-tax money. So when I start annuitization, so when do Uncle Sam ask me for my taxes?
Every year. Yeah, when you do the distribution, there's a 1099 that you will receive. every year.
So every year. Okay.
So when
Thank
you
you.
file taxes, yeah, you just include that.
Mm.
Another thing. So it's not really beneficial if you have a lump sum of money, but you roll it over on an annuity at a later stage of your life, like say age 72, 70 to almost the time when you are supposed to receive your RMD, because the money, the RMD will be deducted and to the principal amount that you have rolled over. So your expected additional income at the latter part of your years when you're 75 or around 75, it's really gonna be much less than what you will expect
Yes.
when
But-
you rolled it over.
Yeah. So yes and no. Because, for example, if it's a case by case basis, because let's say the client situation is that I want $10,000 income when I retire every single month, and this would include Social Security for both husband and wife. And if we look at even the table today, as far as income, Social Security income, the max income that you can get on the Social Security today is $3,600. So regardless if you make $2 million, $2 million a year, the max you can get right now with Social Security is $3,600. So if there's two of you, so that's $7,200. Now, if you have this strategy on your money, so if you have, sorry, let me go to the income right here. So if you have 7,200 right here, adding an additional 33,000 would give you that $10,000 per year. So so yeah, you could technically say, hey, you know what? If the concern is, well, I want some legacy for my kids, then perhaps before you put your money into an income annuity, maybe consider half of this, put it as an income, or maybe do a third. So depending on what the gap is that you need to meet that monthly lifestyle income when they retire. So that way they're still going to be, because a lot of times most people would say, hey, I want to be able to leave something for my kids. Then there are other strategies where you can put, let's say, for example, the 384, but instead of getting a 37,000 income out of this money, you'll get a lower, usually maybe around 25K. So I'll give you an example here. Let me do, like, as far as the illustration is concerned, I just remembered about the AMS. So you guys know about the AMS for the licensed agents? 1 second. You guys see this?
Yes.
Yes.
Okay. So one of the good tools to use with AMS is this one, Annuity Now, remember there's fixed annuity, fixed index annuity, and then there's the variable. So if, for example, you have clients who says, hey, you know what? Hey, Dan, can I have a CD and I don't like that FIA thing. What else can you offer me? Is there something like similar to a CD? So the fixed annuity, like this one here, Athene. So a 3-year fix, you get a 5.75% rate of return. So year 1, year 2, year 3, there you go. That's a sale for you. It's like a hybrid CD. So it's safe because one, you're not going to lose any money. You're going to get the 5.75% rate every single year for the next 3 years. Now, it's also probate proof because if, God forbid, anything happens to you, whoever you elect as beneficiary, it goes to your beneficiary, no questions asked. And then the liquidity, if for any reason, during the course of that 3 years, if you need money, it would allow you to take 10% out. So there's some liquidity as well. CDs doesn't have that. If you do take it out, they'll penalize you for the interest earned. On a fixed annuity, they don't. And then the interest on this is basically it's not going to fluctuate. 5.7, it's pretty straightforward. 5.75% for the next 3 years. And then when they say, hey, are there any fees? Hey, no fees on annuities. And then how about taxes? So CDs, they get taxed every single year. You'll get a 1099, while an annuity, like in this, either fixed annuity or fixed index annuity, you don't get taxed until the end of, or until you take money out. So in this scenario, assuming you have a client that would say, hey, Ivy, I have 100,000 right now to work with. What can you give me that would give me the highest income? So this tool allows you to, get an estimate of who can give me the highest income. So I just basically go to AMS, go to Rider, and then I'll just do Rider quote. And I'll just say here, like John Wick. So let's do John Wick.
Age, gender.
Let's just say he's 62 years old. And then the state is Nevada. And then he wants to put in 100,000. And then right here, it says, I want to wait at least 2 years before I want to take the income. So I put 2 years and I run it. You guys see this? So based on this particular scenario, Athene is actually saying that, hey, you're 100,000. I'm going to give you 30% income rider, okay? Rider bonus. And then the 100,000 is going to give me 8,316 per year. And then remember the enhanced payout, that's the one that if you can't function 2 out of the 6 activities of daily living, that's the enhanced payout amount. So, but that's after 12 months and 1 day. Then you say, okay, well, the other one, AIG, it's going to give you 7. So really, in this scenario, the Athene is the winner in this particular I guess the scenario that we have for income. So this is a good tool to use if you want to come up with who can give my client the highest income. So if we rerun the scenario and create another one. So we basically just go new writer again, and let's just say, Dunwick again. Now fast forward, he's the guy 67, and then Nevada, and then let's say it's 250,000, and then he wants to take it at 72. Run the quote. So earlier it was a theme. Now you see here it's remember the example earlier when I said there's a period certain, life with income certain. So this one here, the strategy with AIG, is that the 250,000, you're getting the first the 13 for the next 13 years, you're going to get this income, but after that, it's going to go 18,000. It drops. It's from 5%. So now, then you go, okay, well, if you compare this versus this one, I think I would go with Athene. Does this make sense? Because look, as far as the lifetime, look, they're getting 718,000 more. So it's more income than this guy here. So I know it's we're kind of past time, but does this answer your question? Was it Ivy? That was your question, right?
I think so.
That was a good example. Oh, sorry. Go ahead.
Okay, go ahead. So yeah, use this tool. It's, log in to AMS, go to writer quoting, and play with it.
Question.
Yes.
Is the benefit rate, is that guaranteed like all throughout? Like if you get like a 5-year plan kind of?
Mm-hmm.
Okay. And what's the roll-up? What does roll-up rate mean?
The roll-up rate.
Mm-hmm.
So this one here. Oops. Okay. So that's the. Remember the bonus earlier?
Ray, I think it will gonna show up on the detailed report.
Yeah. 1 second here. There.
The payout by age. There.
Roll-up rate there. 10%. So remember the hang on. So the first like 10 years, or see if you look at this Athene, so from 68 to 77, roll-up rate is 12%. And then afterwards, 6%. I'm drawing blank a bit. The question was, what is the roll-up rate, right?
Yeah.
Can you help me out on this, Dan?
Okay. So the roll-up rate is a fixed rate that it will gonna be add up on your income base. So it doesn't matter what happened on the market. If your income base is 325 every year, you are guaranteed to have 12% income base additional. So, for example, on the second one, so it's easier because it's 10%. This is 250. 10% of that is 25,000. So whatever happened to the market, 250. So 10% of 250 is 25,000. Every year, your income base will gonna earn 25,000. It doesn't matter what happened to the market. That's why if you're looking for a lifetime income, if that's the if that's the purpose why we opened the annuity, you don't need to worry about the what you call that, what happened to the market, because the guarantee is really good already. So the income base, that is where they're going to base your lifetime payment. And in order for you to get the lifetime payment, that's the payout rate. So different company has different payout rate. So on a certain age, you can see that the payout rate is different from a teen and this American General. So that's the answer.
All right.
Hopefully you understand it.
Thanks, Dan.
Thank you. Also, like, how do we answer like clients when they ask, "Oh, that seems too good to be true"?
Well, a lot of times, thanks for that question too. So a lot of times they always say, hey, what is the stability of the company? So it's now basically sharing, hey, if it's a theme, you look at the rating of the company. Sometimes, if you see this American AIG, a lot of people are like, I've heard about what happened in the past. Is it going to repeat itself? So I would make sure that you know the strength of the company. So plus WFG, we always deal with high A-rated companies, and we always vet them every single year if they're performing or non-performing. So too good to be true. It's really sometimes it's hard to prove it to the client, but if we can share with them the strength of the company that we're going to be working with, then and show them the history of the company. And so we have to do a research about, hey, Athene right now, they're probably one of the number one top three income annuity providers. And then so yeah, it's a matter of just reinforcing it to the client on the stability. Because then if they haven't heard of the company, sometimes that's the hard part, is if you don't know history wise of who we deal with.
All right, thank you. And Mr. Ray, it's all it's better still to just look at the total lifetime payment, right?
Yeah, because if for example, if the client needs like more income, then yeah, it's you satisfy that need by providing like this the one earlier recent quote, this guy.
Open. Yeah.
Right. So here, see the difference is only not even $2,000, close to $2,000.
But it's always gonna come up with what's the client's goal.
Yeah.
Because I do have a client that's the difference is 10,000. So my client has the annuity that's 700,000. So the American General will gonna give them 61,000 for 10 years, but the second one is only 51. So there's a 10,000 difference. So my client's goal is to enjoy the money when they're still young, because they are always traveling. So they told me that I want the product because after 10 years or 13 years on this example, they are already old. They're not gonna travel anymore. So if that's the goal of the client, then I think the number one is the good choice.
All right.
Mm-hmm.
And then, and this one here, just so you know, the Athene Pro. So this enhance, it's only good for 5 years. So after 5 years, if for any reason they're still alive, then it goes back to the 29,000.
Okay.
Okay. So I think we're. Any more questions? We're good. I think it's 8:00, 8:12. Call it a
Before
night.
guys, before you leave, guys, can we take a picture? Stop share, Han, for
Oh.
the attendees. Let's do a gallery. Okay. One. Turn. Open your.
Giselle, big smile.
Okay, I have to take two, okay? Because there's two pages. All right. Okay. 1, 2, smile. One more. Okay, 1, 2, smile. All right, thank you. Thank you so much for your time.
Thank you.
Thank you.
Right.
Thank you. Thanks to the trainer.
Thank you.
Until next
Thank you.
Monday. Bye-bye.
Thanks for the trainer.
Thank you for the training, Manang Ray.
Good night.
All right. Have a good night.
Good night, everybody.